S. Narain, CIO of ICICI Prudential AMC, joins us with his perspective on the markets and also his view on two funds. One is ICICI Pru Discovery and the other one is ICICI Balanced Equity Fund. Now, just a quick run through of ICICI Pru Discovery before we touch base with Narain. The fund has had decent returns about over a 5-year period. The trailing returns have been about 13%. Those are its average returns over a period of time. Some of the top holdings of ICICI Pru Discovery stock-wise include a Bharti Airtel. Narain, of course, has a contrarian bullish call on telecom. Amara Raja Batteries is the second one. Sterlite Industries, GAIL and Oracle Financial Services. This is a fund which balances large caps versus mid caps. Of course, needless to say, the top sectoral holdings include financials and energy. The second fund that we're going to be discussing is ICICI Pru Balanced Equity, where 70% of the weightage is in equity and 30% of return is generated via investment in debt instruments. Narain, come to you. First up, of course, your outlook on the market as always. After a fantastic start to the year, that's what we saw in Jan. How are you looking at the market at this point?
Yeah, actually, what was surprising is the fact that there was a fair amount of money which came from FIIs, and the market just did not respond to that inflow. Maybe it's because of the good amount of disinvestment which has happened and a few primary market offerings. Maybe that's the reason, but we were very surprised by the fact that such a big inflow that we've seen in the last 2 months did not result in the market going up. Our own view is that we are headed for a period of volatility for the year, primarily because of the fact that you have a political event like election coming up in 2014. And we actually thought that maybe the initial part of the year should be much better because of whatever reform process that has started from September. And you would have more volatility towards the second half of the year. But where we've been surprised is that the volatility has started off right from the beginning.
What are your expectations from the budget at this point? What do you think the event risk is in the big event?
See, I think the clear expectation we have is the fact that we expect them to give benefits to the investors who are invested in financial savings products. I think over the last 5 years, financial savings have started to go down very significantly, and there is a need to incentivize financial savings, and in our belief, this year will be the year where financial savings will get incentivized. So primarily it would be a move away from physical savings into financial savings. Other than that, what we expect from the budget is something not very significant. However, if the budget does serious fiscal consolidation, I think the markets can move up significantly. But for the government to do serious fiscal consolidation, like increases in excise duties, maybe an increase in diesel price specifically in the budget, those kind of steps are a bit difficult for the government to do.
And in both your funds, there's a clear overweight on financials, Discover or the Balance Fund. So between the PSUs, private and the NBFCs, what's the value versus the growth call?
I think PSU banks have been attractive since July, August last year. This quarter's numbers, some of the PSU banks disappointed, some of the PSU banks did very well. I think going forward, the sector is attractive, but it requires support from a lower fiscal deficit. Because if the fiscal deficit were to come down, one of the biggest advantages that you will get in the PSU bank category would be the fact that you get a benefit of lower gilt yields, which will create treasury profits for the banks. As far as private sector banks are concerned, they've done well. They are at the same time, they have actually been the most overowned sector at this point of time among many sets of investors. So while the long-term outlook of the sector is extremely good, the fact that we've seen fair amount of inflows into the sector has made us a bit cautious on the private sector banks, but it's more a tactical caution in my opinion. As far as NBFCs is concerned, there is of course news that some of the NBFCs can become banks, and RBI is likely to come up with their policy on that. Beyond that, at this stage of the business cycle, we are increasingly cautious on some of the NBFCs. and we are actually looking at only the very, very strong NBFCs, because we've always seen NBFCs are a higher risk sector compared to the other kind of things as far as the equity market is concerned.
We'll come to the other rate sensitives in a bit, Naren, but energy is your top pick in the Discovery Fund. Which segment within that space do you like here?
Actually, right now, upstream oil companies look very attractive, and some of the stocks have done very well in the current year, but people have to remember that 2012 was a year where the sector did extremely badly, and possibly a catch-up has happened in January, February. I think again the future outlook is dependent on government policy. There are private sector companies which need government policy changes from the point of view of allowing them to explore faster and get better prices for their exploration. And there are public sector companies which need clarity on subsidies. I think the government is working on both, and the benefits of both these should help the sector over the course of the next 1 year.
What's your view on the other rate sensitives, real estate and autos then?
In real estate, on the equity side, we've rarely participated in them in the last 5-6 years, primarily because we have found it very difficult to analyze the sector, and consequently we've stayed away from equities on the real estate side. On the auto side, we have been a great believer that there has to be a consumption slowdown. The consumption slowdown should happen because of the fact that petrol and diesel prices have been hiked pretty significantly, and we were expecting to see a faster slowdown in the sector at this point of time, but that has not yet happened. So we're still believing that there will be a consumption slowdown, because a consumption slowdown is required for interest rates and inflation to fall significantly, which will cause the next part of the cycle, which we believe has to be focused on infrastructure. But the way the market has been behaving, the consumption slowdown, particularly in sectors like SUVs and two-wheelers, have not yet happened fully. But if they were to happen, I think then we would look at the sector for long-term investment. So right now we have a negative view on the sector, but we're looking to become more constructive once the slowdown happens.
Right, about 6 months back you had a contrarian call on telecom. Does that call still hold?
Actually, that today I was at a conference which had a lot of discussion on telecom. See, telecom is a sector is today a basic human necessity, and as part of the consumption basket, we are in a situation where it's the only sector whose prices haven't gone up, and therefore earnings are really down. And in my opinion, this kind of valuation cannot sustain, and they will have to go up in the longer term. Of course, in the longer term, I expect the prices per minute also to go up reasonably in the sector over the course of the next 3 years. So I think on a long-term basis, the sector is extremely attractive. On a short-term basis, however, I think there's just too much news at this point of time. You have an auction, you'll see news on what could happen in the auction. Then there are always pending litigation in the sector. So all these things are going to make the sector pretty risky in the near term. But if you are a passive investor for the long term, it's very, very attractive.
Great having you, Naren. Thanks so much for taking the time out and joining in and giving us your perspective.